Yeah, thank you very much for the conference organizers for having me here. It's been a wonderful conference. And I'm presenting my project on product proliferation as price obfuscation, evidence from the mortgage market. So as some of you will be personally familiar with, picking a mortgage is a reasonably complex financial decision. And in the last few years after the financial crisis, we've actually seen a 3- to 4-fold increase in the number of mortgage products on offer in the UK, which is the market I study. So you may interpret this as a positive sign in terms of market completion and efficiency, but at the same time, you may worry that that may make the overall market more difficult to navigate for a given borrower. And what's more, I find that even within a homogeneous product class, so sort of narrowing it on all observable product characteristics, such as 2-year fixed rate, 75% LTV, I still find that more than half of all products appear substantially cost-dominated. So you may point to sort of demand-side explanations for that, right? So a given borrower may have a higher willingness to pay to borrow from a specific lender, and at the same time, a borrower may actually not be aware that there was a cheaper option available. So there may be search frictions or sort of behavioral frictions that keep you from finding the cheapest good. Now, if there are these behavioral frictions, we also know, based on work by Gabex and Leibson and Carlin, that there's also supply-side incentives to actually exploit those. So making the price ranking less readable for a consumer. However, the kind of empirical challenge that sort of poses itself in identifying the slightly more supply-driven channel is that obfuscation is hard to measure, sort of a comparative static, and it's also difficult to show that it's supply-driven. So I'm going to propose a framework today where hopefully I can overcome these challenges. And to sort of illustrate the results, so if you are searching for a mortgage in the UK, this is like one of the most common price comparison websites. You'll key in all your sort of observable characteristics, and you'll see that these products, there's actually quite a few of them. So there's only about 30 to 40 lenders in the market, but there's a big number of products that are sort of by default sorted on interest rates. So the interest rates seem to be a salient sort of ranking, and there's a lot of sort of these best buy tables that rank by interest rates. And at the same time, you'll notice that sort of the fees are kind of noted, but literally sort of relegated to the footnotes. So they seem to be less saliently advertised than the interest rates. And to take this one step further, so if you were to ignore, sort of if you take a snapshot from this is for a given month for this sort of reasonably homogeneous product, if you take the interest rate ranking, you'll see that there's sort of some dispersion, but that actually the sort of, say, lowest interest rate products are relatively narrowly clustered here. And now if you open back up the kind of fee dimension, you'll see that there's this kind of hides quite some substantial heterogeneity in terms of fees. And what's more, if you actually look at this from the perspective of the average kind of borrower who borrows sort of the average loan size, the sort of products with the cheapest overall total cost, which is sort of interest rate cost plus the fees, which is probably what you should worry about as a borrower, you'll notice that the cheapest products seem to be, the cheapest 10 products, for instance, here are plotted in green, they seem to be products with sort of medium level of interest rates, but sort of relatively low fees. And sort of you can see that the sort of you can see sort of that there's these sort of cost-dominated products. If you think about this in ISO cost terms, so each line on the curve moves you up another £500. So that sort of illustrates the idea of my paper, which is that lenders can use these non-salient fees to obfuscate total cost. So they'll offer products with higher fees to appear competitive in a salient price dimension, which is the interest rate, and they use fees as an active margin for price adjustment. That's a supply-driven, this sort of proposes a supply-driven mechanism given suboptimal consumer search. Now the challenge here is obviously to also again rule out sort of that this is not something driven by demand, so borrowers having specific preferences over interest rates and fees. And even if this was even if lenders were adjusting these fees actively, they could do that for other reasons. So they could be, for instance, screening for other risk factors. So in order to overcome these challenges, my empirical approach is as follows. I'm going to construct a time-varying lender-specific shock to wholesale funding costs, which is sort of, I interpret that, I'll get to that, as a relative shock to a lender's position in a competitive position. And in response to that shock, so for instance, a 1 standard deviation cost shock, lenders will actually increase fees while maintaining relatively competitive interest rates and increasing the number of product alternatives. And I'll also provide you additional evidence that fees are related to loan size, but not other factors that you may worry about are driven by a sort of a screening motive.
Can I ask you? Yeah. So about the fees, are they always just a fixed fee, like a contract signing fee? Or is
Exactly. Yeah. So.
Payment fees?
So I'll get to that. So I think from a US context, you may worry that fees are sort of it may be a substitute for instance prepayment penalties. In the UK, I would count these as sort of other product characteristics that I observe and that I check that don't seem to be related to your choice. And the fees that I talk about is sort of at arrangement. How much do you pay in fees? Mm-hmm.
And so you also know how many people took these mortgages?
Yeah, I'll get to that. So that's some auxiliary statistics.
So, and also, I know that in the UK, these brokers play a big role in the mortgage market.
Yeah.
Did you talk about that too?
I have sort of some comments. I have some comments in my paper, which is that there was a big shock, for instance, to the sort of the regulated advice that you. So there was a relatively exogenous increase in the amount of brokerage and advice that you would get, and people actually didn't find much differences in terms of like price dispersion and choice. This is one answer, and the other one is that I think this sort of. So people also ask me like, why would sort of like a website, like a search website like that, not show you sort of the total cost? And I think by keeping borrowers relatively uninformed, you sort of recast the problem as sort of like a negotiation. Your kind of bargaining power when you sort of go to a broker, and the kind of principal agent problem is probably exacerbated if you don't actually know, if you're sort of less aware of the total cost. So I think it's sort of recasting the problem similarly. Yeah.
So here is it the lender or the website?
This is the lender. Yeah.
The lender hides the fees?
The lender offers these products.
Yeah, but on the website, it doesn't show the exact fees. Is that
Exactly. So this.
the website or the problem with the lender?
So it's both. So I've actually you can there somebody actually made me aware that, for instance, HSBC recently just removed fees completely from their rate tables. So you have to actually dig quite a lot. This is sort of like an anecdotal kind of support for it, that they don't want you to know the fees or the total cost or the sort of the composite measure of cost.
So so fees are really rent extraction then in your mind?
They're going to be an adjustment mechanism. I'm going to get to that, by which sort of if borrowers, so this kind of suggests, is kind of consistent with this idea that borrowers are probably, which other people have shown, I'll get to that, that borrowers are less sensitive to. So it's sort of you're adjusting prices. If you deteriorate in the sort of competitive ranking, you're adjusting prices along the dimension that which borrowers are less elastic towards. So you're kind of rationally responding to that. So that's why I'm saying this is a supply-driven mechanism, given sort of you sort of conditional on some kind of incomplete, imperfect borrower search. Yes.
Do you know anything about the profit structure of the website?
So this one, for instance, so this is, I think this is also different. This is sort of more anecdotal, but in the UK, these search websites, they all have their own revenue streams, and they're actually relatively opaque. So you don't know why they sort something by default the way they do it. It's not very transparent, and they get their money through commissions.
Yeah, because I worked with the data set in Sweden, similar, and it turned out that they actually have side deals with the people. So, you know, for them it's really interesting to keep
exactly.
Because they get
exactly.
paid, like,
exactly.
contracts that are
exactly. Exactly. So I think there's sort of an equilibrium where along the kind of sales chain, there's an equilibrium in which sort of nobody seems to show these fees very prominently or sort of make it super easy, sort of immediately salient in the total cost. So I think that's sort of consistent with that.
So if you're going to go for one offer, is it binding?
In what sense?
In the sense that if you say I pick the first one, then I will get those terms?
Yeah. So the good thing, this is sort of the UK in contrast to US market, for instance, the products, you will get them as offered. So there's no sort of ex post renegotiation or anything like that. So you'll basically like pick, and I guess sort of what part of this could also be suggesting is that it directs you towards products because you see them first. You see these low interest rate products first towards certain lenders or. All right. So this sort of, these are, I mean, we discussed some of this. So this is related to, for instance, the theoretical literature on price obfuscation as a source of market power. And here I'm trying to sort of propose a framework in which I can measure obfuscation in one dimension and test the predictions from sort of the comparative statics from a model where you price with non-salient fees. And I also sort of link to the literature that has shown that firms seem to exploit consumer mistakes, and sort of showing that consumers seem to be less elastic with respect to certain cost characteristics of certain products. And I'm hoping to sort of add an identification of a supply-driven mechanism using these cost shocks. And lastly, this relates to the literature on consumer search overall, in which I show that there's sort of these supply-side incentives to amplify existing frictions. All right, so let me sort of illustrate the mechanism a bit more that I have in mind. So fees in this context can be interpreted as sort of non-salient price components in the spirit of Gabex and Leibson. So some sort of non-sophisticated borrowers don't sort of optimally substitute away from sort of hidden but expensive add-on products and add-on price components. And also, these fees can also be interpreted in the context of price complexity in the sense that these make the total cost ranking more difficult to read for consumers. And lastly, this is also related to other markets where, for instance, Chetty and others have found that consumers seem to underreact to taxes that are not saliently added to your purchase price. So with that in mind, the prediction should be that if consumers search optimally for a given mortgage product, they should minimize total cost in this case, which is interest rate costs plus the fees. But if fees are not fully salient, then there's an incentive for lenders to reprice the products in the direction of the salient cost dimension, which is interest rates. So to illustrate this, and sort of these are the basic ingredients for the model that I have in mind. So suppose there's sort of two types of heterogeneity to the extent that consumers are elastic to total prices. So there's informed consumers who always choose the cost minimizing product no matter the price frame. And there's uninformed consumers who choose randomly from a set of products with low interest rates. So this is sort of a way to capture that they neglect these salient fees and overemphasize interest rates. Now suppose also that there's sort of different types of lenders, then low-cost lenders will have an incentive to offer the minimum cost product in order to attract these informed consumers. But high-cost lenders can't attract these informed consumers, but can capture the uninformed by kind of pretending that they have a low interest rate and sort of pretending to have low cost. So in that sense, you get a separating equilibrium in which these lenders kind of specialize. So low-cost lenders offer the cost-minimizing products, and these high-cost lenders obfuscate. So it's a kind of a stylized way of capturing the price dispersion that we've seen. And the prediction would be that high-cost lenders use fees and issue products at different fees to match the lowest interest rate in the market. So the comparative static would be like if you turn from a low to a high-cost lender, you would increase the fees rather than the interest rates. So
are they high cost? Why are some low?
Oh, so that would be a shock to funding costs. So this is where the identification strategy will actually come in. So suppose there's sort of each round we start from scratch and you get a shock, and it's either a high or low shock, cost shock.
So only some people are shocked, some people are not.
Exactly. Yeah. Exactly. So
Yeah, I know.
lenders. Yeah.
Calling banks people.
Yeah. Exactly. So maybe yeah.
Learning then in your model. So if I'm not informed, why don't I just mimic the informed and go to the same lender?
So I thought about this. I had a much more. So when I first thought about this market, I had a much more complicated kind of dynamic optimization problem, given that people also refinance, right? So there's this dynamic component in the way that you can capture that you should actually try to capture. Maybe that was my prior actually. Thought they were much worse than maybe that was a biased prior. So I looked at that, and I was looking actually at price components that, for instance, like the early prepayment penalty, that you sort of make the product look good up front, but then actually like charge really high prepayment penalty, increase your prepayment penalties in order to keep borrowers in a dynamic kind of optimization problem. And that's actually not what happens in the UK. So there's these papers, I don't know if you're familiar with them, but sort of the UK is quite specific in terms of the typical mortgage product. So the typical mortgage product is a 2 to 5 year fixed rate product, and people refinance after that, after the expiry of the fixation period. So people have actually used this for identification. You get these nice sort of almost exogenous refinancing paths. And that kind of suggests that there's not that much heterogeneity in prepayment penalties. So that's to that part of the. So and in terms of learning, I guess you could interpret it, so there's these models, this is sort of taking actually a step back. There are these models on price dispersion, so you kind of get like a mixed strategy equilibrium of that model. So I actually take a step back sort of to get a comparative static. But you could think about this if you interpret the mixed strategy model as something that you can take to the data, it would be something like these lenders get different cost shocks, they mix, they kind of change their prices. So it's not clear that a lender that was cheap before would be cheap in the next period. And I can confirm that in the data, right? There's some level differences in funding costs, but there's also actually like if you plot at the ranking who's cheapest in a given month, there will be some heterogeneity. So it's so I follow the data and kind of do not model that explicitly. That you would learn from that. All right, so illustrating this kind of framework a bit more. So suppose there is this low-cost lender and offers a low interest rate product with sort of normalized 0 fees. And suppose there's a high-cost lender who would offer this sort of higher interest rate. Now, if borrowers aren't sensitive to the fee dimension, then that would be, rather than having these like total ISO cost curves, you would have these borrowers are as if they only care about the interest rate level. Right, so these would be sort of flat ISO interest rate curves, and what you would do then as a lender is to actually match the lowest interest rate and charge a higher fee. So that's the kind of idea. And then the comparative static is sort of if you are shocked, if you become relatively more expensive in a given period, then you would try to still match the interest rate in the market, but sort of increase the fees. So that's this kind of relative cost shock that I have in mind.
So why isn't it easy for someone to come in and start advertising their fees and saying that they're better than everyone else?
So this is Gabek's Leibson, right? Like from the scratchbook. So it's this kind of like there's a curse of debiasing that you can't capture the people that you debias. Like they will probably go to they will still probably go to the other lender if it's kind of costly to advertise. And I guess so at the same time you have these products that have 0 fees and so it's for me that's sort of not a counterfactual but sort of a cross check of where the interest rate ranking becomes fully salient, right? So you have an equilibrium in which if you are a low cost lender you should signal that, right? And so you charge 0 fees and sort of the interest rate ranking immediately shows who's more expensive, right? You do get that as well. So this is sort of one point, and I'll show you in the outcome data that I do get this kind of specialization, that low-cost lenders do have most of their market share in these 0 fee products, and only a few high-cost lenders have these high fee products. So it's this specialization argument. Did that answer your question?
But so when you refer to this Cabet paper, one of the crucial elements in this is that you should be able. So the reason why they are unable to unbias is because you can avoid.
That's right. So the reason.
This is why I ask you about.
No, this is why. Yeah.
So if it's not correlated with anything where you have control over.
Yeah.
Then I mean, if it's signing fees, I would agree with René that. Then
no, I get so.
Capture the market.
Yeah, no, exactly. So I agree with you that sort of the crucial difference in my setup is that you can't substitute away from these fees. You pay these fees. Yeah, so within a given, if you want to choose a lender, you can't actually be the smart one and avoid these fees. So it's rather than that, it's sort of choice across lenders, right? So the smart ones would always go to the cheap. So rather than like choice within lenders, where you have this debiasing, which is more sort of textbook Gabek's Leibson, you get in this market you get this kind of specialization across lenders. So you have an incentive for some lenders to specialize if they can, if it's their comparative. Think about it as like their comparative advantage. Yeah. All right. So with that framework in mind, let me move to an empirical analysis. So I'm combining 3 different data sets. The first one is a product level panel by Monifacts, which captures the universe of UK mortgages on offer over time, including detailed product characteristics and interest rates and fees. And I add to that sort of a lender panel to observe the sort of balance sheet information and importantly funding cost information and the collapsed product characteristics to build a panel. And I'll complement that analysis using the actual borrowing outcomes using an administrative data set from the FCA with borrower and loan characteristics. So I built this panel with sort of the largest UK lenders and sort of focusing on a reasonably sort of controlling for observable characteristics and focusing on a reasonably homogeneous product category. So the idea here is to build, I'm trying to build a relative cost shock to lender's competitive position. So that requires a lender J time T specific shock. And the way I do this is to sort of construct a simple Bartik shock to a wholesale funding cost. So I'm using the predetermined exposure to the shock. So prior to the start of my analysis, and this is sort of robust to other years, I use the loan to deposit ratio as a measure of how dependent you are on the wholesale funding. So if you have a good stable deposit base, then that ratio would be low. And I interacted with an exogenous aggregate shock to a wholesale funding cost using the LIBOR swap rate and CDS spreads. And the main specification is I'm asking how do banks adjust pricing and products in response to a relative cost shock. So I'm regressing my outcome variables of interest on changes in a funding cost variable with a time and lender fixed effect. And the identifying assumption here for the interpretation of my results is that this identification strategy should have that changes in the funding cost shock are exogenous to any lender time-specific unobservable variation, for instance, in demand. So if you're worried about sort of demand-driven explanations driving the results, I would rule that out with that strategy. So let me move to the results, which is, as I said before, so I'm looking at average interest rates and average fees. And so you see that average interest rates don't do much. If at anything, they go down a little bit. And average fees increase by about £60, which is about 10% of the average level of the fee. And sort of total costs go up. So it's kind of like a relative shock to your overall cost. And if I split this result a bit further, I look at sort of low fee products and high fee products, you'll see that this effect is driven by the highest fee. So lenders increase the highest fee, which relates to the lowest interest rate that they offer in the market. So it kind of shows you, it's probably intuitively consistent with the idea that sort of having the lowest interest rate is a salient feature in the market. And lastly, I linked this sort of more in order to sort of get a sense directly of having this additional price dimension. Lenders seem to also increase the number of products that differ in fees in response to this funding cost shock. So with a 1 standard deviation shock, the number of all total products goes up by about 20%. So I'm going to skip the findings in the interest of time, which I've just told you, and sort of talk a little bit, sort of illustrate a little bit more the alternative channels. So we spoke about prepayment risk already. Which does not seem, so I also looked at sort of the prepayment penalties that I observe, and they do not seem to vary within a given lender. So in the US, you have fees that are actually these points that sort of signal lower prepayment risk if you take these fees. And in the UK, you can do that more directly with these prepayment penalties, and they don't seem to vary even within a lender and across fees. So it doesn't seem to be a main concern or a main margin at which lenders seem to be pricing things. Next, there's sort of other motives, for instance, like screening for liquidity constraints. So you may not be as able to like pay down the fee if you're very liquidity constrained. And lenders may have a preference for fee income, which sort of average fees seem to be a bit higher in the crisis years, but it seems less likely given the institutional setup, the way sort of lenders allow borrowers to borrow their fee. So lenders do not directly control this margin of if borrowers actually directly give them a fee or add them to their loan balance. So it doesn't seem to be as likely that that's the main source. And there is some kind of relationship between the fee that you take out and loan size. So if you have a bigger loan size, you should be more likely to pay the fee. But it seems less sort of, it doesn't seem consistent with the way the market is currently marketed. And we can talk about that a bit more if you're interested in that. So lastly, very briefly, to just sort of have some supportive evidence on the borrowing and sort of mortgage outcome side. So this is a profitable strategy if there is this kind of, if consumers actually do make these mistakes. So one proxy for measuring these mistakes is to sort of calculate the total cost that in the mortgages that they take out, regress them on a bunch of outcome variables, and basically looking at the residual, which gives you a sense of the magnitude, how different was the price that you paid relative to people who were similar to you. And if I plot that residual, the density of the residual, you'll see that it's a bit bigger for products with fees. And in particular, for products with higher fees, you kind of get this right side hump. So there seems to be greater cost dispersion with fees, in particular for high fees. And lastly, this is the sort of this is what I alluded to earlier, is that If you are a low-cost lender, then the interest rate ranking becomes fully salient at 0 fees. So you should be making more of your money in that category, and that's indeed what I find. So I find this negative relationship with cost, and you're sort of within a given lender at a given point in time. How much money are you making relatively from low-fee products? And the reverse is sort of seemingly true for high-fee products. So there's some evidence, some tentative, sort of suggestive evidence for that degree of specialization. So to conclude, I've provided you evidence that lenders seem to obfuscate prices with non-salient fees. So I've sort of offered a framework to measure obfuscation and lender pricing strategies. Fees in that interpretation allow lenders to issue cost-dominated products that look competitive in the salient price dimension, and sort of the sort of additional price dimension allows, sort of gives them an incentive to have these different products at different fees, so hence the product proliferation. And it's a potential supply-side amplification mechanism behind suboptimal search in the mortgage market. And it's important for competition and the pass-through of monetary policy in the presence of behavioral biases. Thank you.
Thank you. Again, we have 5 minutes for questions.
Yes.
Well, I'm not familiar with the literature. By the way, this was fantastic. But so I'm just wondering whether these products are indeed homogeneous. Because, you know, I was thinking maybe I'm willing to pay the higher fee if I know that my chance to refinance at a better rate down the road is, you know, is better. And that could drive this, including your, you know, your experiment, because when my competitive position deteriorates, then my ability to serve my clients will be worse, and therefore that's why they change the fees accordingly. And I think that is key.
No, I think that's a very good question. So one way to sort of alleviate that concern is that most of this analysis is focused on very low LTV relatively low LTV products. And within a given LTV, there's not that much. So UK, because these products seem to be relatively sort of like the average borrower takes out like a 2-year fixed rate product. There's only this kind of acceptance rejection margin based on your FICO scores. That sort of there's only one margin where your FICO score kind of where this kind of approval process and the probability of getting accepted matters. And the sort of that I can see from sort of how lenders price. There's sort of these credit models by these lenders, and they don't differentiate if you take out a fee or not. So that doesn't seem so. There's obviously always these concerns, and sort of to the extent that I can control for observables and sort of like think about these things, it doesn't seem to be too concerning. Yes.
Now, I had more clarification questions. So what do you, as a consumer, have to fill in? So now you mentioned the FICO score. So because I also wonder, so that's one question, like what as a consumer do you have to fill in? But also as a lender, do you simultaneously bid against each other? Is it an open bidding? So how do they coordinate on the interest rate? So how do they make sure that
they just post them, right? So it's a bit of a coordination game. I think you're second guessing, as long as there's no like official collusion, which would be illegal. They kind of you kind of think what the rates were. You see the rates yesterday, and then going forward, you kind of look at your own prices. Your treasury department is going to tell you, like at which margin you kind of probably need to like achieve whatever, like last quarter's margin or something like that. So it's kind of a strategy. You kind of choose the best strategy, conditional on all other people's strategies.
Yeah, so there's no sequential. I thought otherwise timing might also drive the choice of contracts.
So that doesn't seem to be
instantaneously. Get the offers.
So think about it like I think the way the market works is really like some people have talked about this as like a supermarket setup. So it's like posted prices. You see them. Competitors see sort of previous time period posted prices, and borrowers can pick from that.
Go ahead and apply to many and then see all the conditions, because ex ante you only see the interest rate, you don't see the fees.
You should actually look at the fees before you go and go through the mortgage approval process.
Okay.
Yeah. So in response to.
But is it electronically done, or is it done? Then you have to do it.
I think you have to. In the last stage, you have to show up face to face. Yeah. So you don't submit lots of things. Like in the UK, you don't have to the approval process is a bit simpler. Like they will check your credit score, and there's going to be a like yes or no decision. But with relatively low LTV, I think this is much more a concern at high LTV. And actually there I don't find these results. So that's also kind of consistent with this idea. I think at high LTV you would probably, if you think that you are actually drawing unsophisticated borrowers to yourself, you should, if that's correlated with default risk, you would probably not do that. Yeah. So. Yeah.
Take one more question from
Yeah, it's more of an observation rather than a question. So in the US, there is this Truth in Lending Act that basically says that lenders need to disclose all fees and points. So fees are fixed and points are quoted as a percentage of the loan. So basically, when you open the money supermarket equivalent in the US, you will have the interest rate, the fees, and the points, and then the equivalent APR, which will then provide the comparison across different products. So having in mind that, what would be what do you think would be the policy implications of what you document in the case of the UK market?
So I think this is a very good question. So I think people have found this across a lot of sort of seemingly homogeneous retail product or other product markets. And what I would say here in the UK, so in the UK we have an APR as well, but it's kind of, I think people are happy to show is sort of what I derive from this, because the majority of your duration of the mortgage is floating. So there's a lot of lender level discretion actually there's like a time varying lender specific premium that they actually hiked up. I wanted to write a paper on it. Well, maybe I'll do it. But like they hiked that up after the financial crisis. So when interest rates were rock bottom and there was QE and everything, these lenders actually increased their variable sort of standard rates afterwards. So your APR is going to capture to like 3/4 is going to be that, and it's going to under. So it's not a very useful metric to make decisions. I think if you're in expectations, you're going to refinance every 2 to 5 years. And what was the other point? Policy implications from that. I think if they were to coordinate, if somebody was to sort of legally mandate one salient metric, this type of research would tell you that there's probably a strong incentive to deviate from that, right? So it's a bit regulation is always whack-a-mole. I wonder. So one thing that would be a slightly more detailed hypothesis would also be that maybe the magnitudes matter. So this idea of like Bordalo-Genaioli-Schleifer, this kind of salience idea that you think sort of you think in percentages. So like 10%, like interest rates, deviations from interest rates, you think sound much bigger, like 5 bips of 2%, rather than like £100 of 1,000 fees. So like fees in that sense will always be slightly less salient than interest rates. So there may be something going on with that when you have different metrics. Or if so I wonder if, for instance, if you were quoting these interest rates in cost, maybe you wouldn't get that effect, and maybe people would weigh this together. Yeah, but okay, cool. Thank you.